let's come to global economy. OECD is lowering global growth projection because of current uncertainty. More importantly, global PMI is now getting on the lower side of the growth. If we divide the world, there are countries where inflationary burst is happening because of variety of factors, like Russia. There are countries where inflationary boom is happening, like Japan, Hong Kong, Taiwan. There are countries like Denmark and Turkey which are witnessing disinflationary burst. And then there are countries including India, US, UK, China, where disinflationary boom is going on. This disinflationary boom is the golden spot. Economic activities are high, but inflation is not yet a problem. This puts India in a better position. If we look at China, they are probably rerouting their exports to US, EU, and Japan via other countries like Vietnam, Thailand, and so on and so forth. Chinese economy remains heavily dependent upon investment. Their share of investment remains in the 40s, whereas consumption has failed to pick up above 40s. China does carry large debt to GDP ratio, almost touching near 300%, and majority of debt is owned by corporates, and many of the corporates are in turn owned by the government. Despite all the challenges, China, India, and US continues to remain engine of the global growth. The world will grow provided China, India, and US continues to grow. If we look at in this geopolitical uncertainty, gold has outperformed significantly all other asset classes, including government bonds, equity, and commodities. If we see globally, there are countries where interest rates are easing and equity markets have delivered positive return. This is understandable. There are countries where interest rates are being eased by the central bank, and despite that, market yields have gone up. Policy rates are cut, market yields are going up, and despite that, equity markets have delivered positive return. Normally, this doesn't happen. And on the other hand, we have countries where interest rates have gone up, market rates have moved indifferently, and yet equity markets have delivered positive return. Undoubtedly, markets, despite all the geopolitical uncertainty, continues to remain well supported. This is the Gavekal view on global equity based on fundamentals, momentum, valuation, policy support, and positioning. India remains one of the favorite market, except on the valuation side. This is view on various sectors, and clearly energy and materials. These are the two sectors along with financials globally which look on the positive side. On the other hand, consumer discretionary space looks negative because of challenges on visa, tariff, and travel. Growth requires credit, but look at the countries in terms of debt to GDP ratio. Japan, Canada, US, France, China, they all seem to have debt which is fairly high. Obviously, this is total debt, not just government debt. And at that high level of debt, will they be able to borrow? In fact, many a times looking at this table, I believe higher the debt, higher the rating. Lower the debt, lower the rating. Somewhere rating agencies continue to show they are moody and they have very, very poor standards. Coming to US economy, the March 25 quarter showed negative growth. It's degrowth. It is below expectation, partly driven by very large fiscal deficit and $37 trillion of debt. Now, US government pays about $1 trillion in interest. Almost 15 to 16% of their budgeted revenue goes in payment of interest. President Trump has come with one big, beautiful bill. This is cutting some expenses like Medicaid and giving tax rebate to middle-income taxpayers. Overall, this big, beautiful bill will end up increasing American deficit by more than $3 trillion. The debt ceiling of America is being revised upwards to $41 trillion. Clearly, America is going to that territory which very few countries have dreamed of. On top of it, their policy remains as confusing as this Pollock painting. By virtue of those uncertainty, we have started seeing cracks appearing in consumer sentiment, job creation, and investor confidence. The FOMC projections probably reflect this, where real GDP growth is coming down and inflation is going up. This is what is known as stagflation. Inflation is higher, growth is lower. And FOMC itself believes that US is heading in that direction. The headwinds to American growth continues to move from tariffs, retaliatory tariffs, uncertainty about trade deals, and so many other things. From an asset class point of view, as inflation has come down in US and Fed has not cut rates in expectation of rising inflation, their Treasury inflation protected yield TIPS is now trading at one of the higher level in last almost decade. In last whole decade, TIPS have not traded above 2%. So it will be fair to say that American fixed income market today is providing real return. On the other hand, American equity market, after 14 years of outperformance, looks overpriced compared to other emerging markets. Since 2011 till now, American markets have kept on outperforming. Emerging markets looks far better vis-a-vis American market. Why does this matter? Because global investors own more than $55 trillion worth of American assets. They own 20% of American stock market, 30% of American treasury, and 30% of total corporate credit. Collectively, they own roughly about $55 trillion of American assets. We believe, despite going back and forth, US tariffs will settle down somewhere in single digits. Some countries may get unlucky with double-digit tariffs, but overall effective tariff rates should come somewhere around high single digit, low double digit. Coming to Indian economy, headlines have been fairly positive. We have overtaken Japan to become fourth largest economy. More importantly, this growth has been created on an inclusive basis, housing, LPG coverage, water tap, solar rooftops, sanitation. Clearly, there has been remarkable improvement in India. We have also broken into top 5 manufacturing hub. Now we manufacture more than countries like UK and France and Russia. I'm sure over a period of time, India will be top 3 manufacturers in the world. The best part about India, we have achieved growth between subprime crisis to current level without resorting to debt. Between 2008 to 2024, the only major economy which reduced its debt to GDP ratio is India, while corporate India and households have deleveraged significantly. Government to fund COVID expenditure has borrowed money, but overall India as a country has reduced its debt to GDP ratio. This is reflected in India's re-rating. The gap between 10-year India and 10-year US Treasury yield in 2014 was about 6.34%. Today, it has come down to 1.89%. Undoubtedly, markets have started re-rating Indian credit. In emerging market, India has one of the highest composite index score. Compared to our peers, we are in a better position. The food grain production this year will be about 300 and so the food grain production last year was record high at 354 million ton. With good monsoon, this year's food grain production should cross that number. Rainfall is 9% above long-term average till 30th June, and the latest numbers suggest it is higher by 13% over long-term average. Reservoir levels are well above their long-term averages, and now they are almost 45% of total capacity. Because of good monsoon and reservoir level, Kharif sowing season has picked up and it's up almost 11% compared to last year. India ink capacity utilization remains in 75% range. PMI manufacturing remains in expansionary zone. The government capex has begun with a bang. Unlike last year where elections constrained government spending, this time government is betting on the front foot. The listed corporate collectively are sitting on huge amount of cash, and their spending is likely to exceed government capex this year. Despite corporate leverage at 15-year low, the capex growth, although bigger than government spending, is in terms of year-on-year growth coming into mid-single digit, coming into low double digit, about teens compared to 20% earlier. If your domestic investors are not investing, you can focus upon foreign direct investment. While gross FDI continues to remain in the $70 billion plus range, it is the repatriation by companies like Hyundai, Whirlpool, and private equity players, and also outward FDI by India, which has reduced net FDI to just about $400 million. Undoubtedly, this is one area which requires government's support. GST collection, after record growth in April and May of about low double digits, has declined to 6% in the month of June. It might be more due to the monsoon impact, as monsoon this month had begun well in advance. On the consumption side, Rural consumption was doing well as suggested in gray bar. Urban consumption has started picking up over last couple of quarters. Hopefully, we should see overall consumption picking up. Tax rebates of about 1 lakh crore will put more money in the pockets of consumers. Interest rates have been cut by 1%. That should also put more money in the pockets of consumers as their EMI burden comes down. Oil prices seems to have moved towards 60 plus handle from 80 plus handle despite Israel Hamas and Israel Iran war. There are talks about potential cut in GST rates that could reduce cost to the consumer from two-wheelers and cement to health insurance premium. That will be bonanza for consumption. Undoubtedly, if that kind of GST cut happens, then divestment will become critical. PSU valuations have gone up and government does have room to divest more. Coming to equity market, after many years of outperformance, this year we have started underperforming our peers. Countries like Korea, Germany, Brazil have done exceptionally well over countries like India. Against 8% dollar return year to date in CY25. Some countries like Brazil, Germany, Korea have delivered better return. Even MSCI emerging market at 14% is outperforming India. If we look at returns, Nifty returns, large cap returns for last decade since 2016 till now is positive. This is longest streak of positive return. In the mid cap space, there has been couple of negative or down years like CY18 and CY19. The same thing is there in small cap where apart from 18 and 19, even CY22 delivered negative return. For some time, we were talking about overweight large cap. Finally, large caps have started outperforming small and mid cap. If we see last 6 months, the Nifty 50 delivered 8% return, double that of mid cap and substantially that of large cap. Rupee remained almost stagnant. Crude prices corrected from 70 handle to 60 handle, and gold went up in last 6 months by 25%. FPI flows were negative, but domestic flows compensated. IT and retail was underperformer in Nifty. Defense and insurance were outperformers in Nifty. Market cap to GDP remains at 127% of GDP, substantially above average of 87% of GDP. But do remember, the profit to GDP ratio is also at all-time high of 5%. Our share in global market cap peaked up at about 4.6% last year, came down to 3.6% towards beginning of the year, and now is hovering around 4%, little higher than India's share in GDP at 3.4%. Corporate India's profitability has grown significantly. In FY20, it was 4 lakh crore. Today, it has become 18 lakh crore, and correspondingly stock market capitalization has also gone higher. If we break down Nifty 50 index revenue, June 25 quarter Nifty 50 earnings are expected to grow at 7%, and this will be a single-digit growth continuing for almost last many quarters. Since June 23, Nifty 50 earnings are growing on a quarterly basis in single digits. EBITDA is expected to grow at 6%, little more than the net profit growth. Sorry, this was revenue growth of 7%, EBITDA growth of 6%, and profit growth of 5%. And last almost 5 quarter, Nifty 50 EPS growth is likely to be in single digit. Contribution to profit will be driven by telecom, oil and gas, cement, and logistics, whereas auto and private banks are likely to disappoint by showing negative growth. Oil and gas PET contribution is likely to sustain at a higher level. And as I mentioned, now profit to GDP ratio is almost 5.1% for listed company. This is one of the highest in last many years. Valuation wise, large, mid and small continue to trade at a premium to historical valuation. But keeping in mind that B2B companies have been replaced by B2C companies like Titan, like Trent, large and mid cap, I believe, are trading around their historical averages. Small cap obviously is at a significant premium. One way to look at this valuation, the 10-year average price to book ratio is 2.8, but it's currently trading at about 20% premium to 3.2. But also remember the 10-year ROE was 13.8. Today, ROE is 15% and expanding. Higher ROE does require higher price to book. DIIs have been big buyers of domestic equity. FPIs, after selling throughout mid-23 to beginning 25, have now turned buyers for last 4 months. March, April, May, June, they have been on the buying side. FPI buying could be probably traced to their underweight position on India compared to India's weight of 18% plus in MSCI index. The FPI ownership is at about 16%. Probably they are using correction as an opportunity to add to India portfolio. In last 5 years, stocks have delivered fantastic return. 300 stocks have delivered more than 100% return in last 5 years. Valuation wise, 183 companies are trading above 50 PE compared to 79 5 years back. Last 5 years, small and mid cap delivered 20% plus return and broad market delivered 17% return. Before that, for 15 years, large and mid cap delivered 11% return and overall market was also around 11%. 20-year average market return is 12%. Large cap again 12%, mid cap 15% and small cap 12%. We believe if investors are coming with this kind of return expectation, they are likely to be disappointed. If investors are coming with this kind of return expectation, probably that's easier to manage. Do request your investors to moderate their return expectation. India is a fairly priced market. This kind of returns are unlikely to materialize in the days to come. Overall, President Trump's tariff policy, FPI flows, Indo-Pak tension, consumption revival, geopolitical risk like Israel-Hamas, Israel-Iran, and most importantly, June 25 and beyond quarterly earnings will continue to shape the market. Our market is also witnessing large selling by promoters. Many are selling to book profit, but many are selling for exit as their fund's tenure is coming to an end. Many are selling because of family settlement. We take promoter selling as a red herring and increase our due diligence to find out why they are selling away their company. Jane Street is one entity whom SEBI has fined about 4,000 crore. Today in Financial Express, I have written an article. Those of you who are interested in knowing about Jane Street probably can go through that article. Our view on market remains overweight large cap, underweight small cap, but overall neutral weight to equity in a fair value market, but with moderate return expectation. In terms of investment, on a rolling return basis, our funds continue to generate better return than benchmark indices across equity and fixed income funds. On a point-to-point basis, small cap fund has underperformed benchmark index significantly on a 3-year basis, and mid cap has underperformed benchmark index marginally on a 3 as well as 5-year basis. Some of the other funds across equity and hybrid have continued to deliver outperformance over benchmark index on a longer term basis. SIP, again bearing small and mid cap, have delivered better return in our funds vis-a-vis index funds across both debt and equity. In terms of current recommendation, these are some of the funds: large and mid cap, contra, multi cap, and quant, which you can look at it. If you are looking sectoral theme, consumption and banking and financial services does look appropriate. In terms of passive investments, now we are a fairly formidable player with most of our funds having lower cost and tracking error compared to our peer group. We have index and ETF fund across thematic funds, broad market indices, commodities like gold and silver, as well as global funds like Nasdaq 100. If there is a correction from our passive portfolio, we'll recommend you to have a look at this passive funds. Coming to debt market, US inflation has softened, but it remains above Fed target, and hence Fed is deferring rate cut decision from 4 to 5 cuts in CY25. Now expectation is of just 2 rate cuts, and that also towards the end rather than in the beginning. RBI continues to support growth through liquidity infusion, through open market operations in bonds, and also increasing flexibility for gold loan financing, infrastructure financing, and priority sector guideline for small finance bank. Inflation has remained well within RBI's mid-target range. Liquidity has been surplus thanks to RBI's infusion of about 10 lakh crore in liquidity. If we look at today interest rate curve, maximum contractions have happened at the short end as repo rate has been cut by more than 100 basis points. There is virtually no impact between 30, 40 and 50-year gilt despite rate cuts of almost 1 percentage point. We believe this part of the curve, 30, 40, 50, looks attractive from an investment point of view. India has completed 1 year of inclusion in JP Morgan government bond indices. Total active debt FPI have invested 92,000 crore, and passive debt FPI has invested 1 lakh crore. Surprisingly, all throughout April, May, June, passive funds were seller to the tune of 31,000 crore. On the debt side, Harfan Mola fund is income plus arbitrage fund of fund. 60% of the fund is invested in debt funds and 40% goes into arbitrage fund. Collectively, if you remain invested for more than 2 years, capital gains in growth plan will be taxable at 12.5%. This is one of the best product to offer to your customers at this point of time. Compared to bank FD, compared to triple rated bonds, compared to direct company deposits, for the similar credit profile, this fund is likely to give better post-tax return. Hybrid debt funds need your attention. They have lower volatility and they have delivered better outperformance. Do look at hybrid funds for your customers' requirement. Gold has seen an exceptional rally since 2022. We became bullish gold since COVID time. We were wrong in 2021, but God has been kind post that. After this rally, there are many questions. Is gold buy at this point of time, or is it time to get out? Well, this is one interesting chart which showed that gold to cross previous high takes about 31 years. Now, there is still gap between the high of the gold in the early 2010s and today. Should we be able to close this gap over next couple of years? Who knows? From our point of view, central bankers have been buying gold. They are like Indian housewife, buy gold and don't sell. There is a race between them and Indian housewife to buy 1,000 tons of gold approximately every year. And the world doesn't produce enough gold to meet demand of Indian housewife and global central bankers. This is what is supporting gold prices. We believe, thanks to President Trump's policy and geopolitical uncertainty, central banks will continue to buy gold, and hence one should invest in gold. Albeit, when you are investing in gold, keep moderate return expectations compared to last 4 years. In silver, the underground reserve is substantially large. However, in case of gold, that number is fairly small. Undoubtedly, gold seemed to have bigger bullish phase, larger, longer bullish phase compared to silver. In silver, there is industrial demand coming from solar panel, and that demand probably can support silver prices in the days to come. Silver hasn't traded above $36 per ounce for a long period of time in the history, and technical chartists do believe that there is short-term momentum in favor of silver.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.